Hello friends, welcome to ICICI Prudential Asset Management Company's part of Investor Education Initiative, ETF Simplified. That's the topic of today's discussion. There are quite a few topics which I would like to cover today, and probably by the end of these next 25-30 minutes, the idea would be that whatever your questions are in terms of what are ETFs, what are the kind of ETFs, what you should be keeping in mind while you are investing in ETFs, all of those are probably answered. That's the endeavor, and we thank you all for listening in and joining into this. From a perspective of the topic itself, ETFs. ETFs as a concept is something which was evolved somewhere around the 1960s, 1970s in US. That is part of the passive investing concept. Back when the fund management industry started in US, it was essentially active funds wherein fund managers used to pick and choose stocks on the funds and deliver returns to the investors based on whatever they've picked. As they moved along in somewhere in the 1960s, 1970s, the concept, the thesis, the theories on passive investing became probably a bit more well-researched, well-known. And then probably the first passive fund on the index side was launched. And then the journey of ETFs started somewhere in the 1960s, 1970s. So what are these ETFs? Like we say, the ETFs are nothing but passive funds or mutual funds which are replicating a particular index. Let's take, for example, the benchmark index, as we call it, or the broader market indices, very well-known indices. If you take up any index and the fund replicates the index in terms of whatever stocks are there in the index and the weightages are there in the index, without any active involvement in terms of picking and choosing the stocks, changing the weightages based on the fund manager's decisions, that's essentially what a passive fund is. And if a mutual fund which is based on replication of an index fund, in very simple terms, of fund which is replicating this benchmark index in terms of its stock constituents and its weightages, that is listed on the stock exchanges for you to buy and sell, that becomes an ETF. So in very simple terms, in one line, if I have to put it, a mutual fund which is listed on the stock exchange, which essentially mimics or replicates the benchmark index to the extent that it can within the laws and regulations which are prevalent at that point of time. That is basically an exchange traded fund or an ETF. It's become very popular in India as well for the last 5-6 years, especially since pension funds were allowed in 2015-16 in India to invest a part of their corpus in ETFs. We've seen ETFs grow. And passive investing, of course, in US as well, or in the globe, has increased or its significance after 2008 financial crisis, wherein a lot of the pension money started moving towards passive investing. In India also, over the last 3-4 years especially, and last 12 months, there is growing interest among investors to invest in ETFs. So let's decode what ETFs are all about. And like I said, ETF is a word which is very simple. It is a mutual fund which is listed on the stock exchange, and you can buy and sell in smaller unit sizes as low as 1 unit. And of course, as an investor, much like you buy and sell a share, you will have to buy and sell a ETF unit as well through a demat account and a trading account. So the essential requirements for buying and selling ETFs on the exchange are demat account and a trading account. And from that perspective, of course, it is very similar to buying or selling a share. Another similarity I would say is that if you typically invest in a fund, in a mutual fund, you get the day end NAV. When I say the day end NAV, meaning you get the NAV which is published on the day end if you invest before the cutoff time on that particular day. However, in ETFs, the biggest advantage that an investor has is that based on the market movements, let's say the market has, because of a bad news, because of a bad election result, because of some, unfortunate incident globally somewhere wherein there's been a fall in the global stock exchanges, India also sees a fall. You may, as an investor, want to participate in that fall at that very moment when there is a 5%, 7%, 8%, 3% fall in the markets. ETFs, because they are traded on the exchange at real-time basis, so it's like a share, like I said, it's traded on the exchange on real-time basis. So if the markets fall 3-4%, and if the ETF is also mimicking the market or any index, it may also fall in line with what the market has fallen, and you may be able to participate in that ETF on that live price. In a normal fund, which is not an ETF, you will get the day and NAV. That's one of the biggest differentiators, or big differentiators, I would say, between ETFs. However, of course, from an investor perspective, the popularity has grown significantly also because ETFs are a low-cost way to participate in passive funds or passive investing. And in terms of an investor, you get exactly, you can actually see the portfolio, you can actually see the index and figure out for yourself whether, this fits your style, this suits your style. And later on in the conversation, of course, I will cover which all are the types of ETFs. There are various types of ETFs. India, it is obviously a nascent stage. We are still in the nascent stage as far as the ETF industry is concerned. It is, I think, about 2.5 lakh crores right now. But from a perspective of globe, there are many products which are there globally. In India also, we've seen products in ETF space growing across various categories, and I will come to that when I cover the product part of it. If you look at from a perspective of, how are ETFs passively managed and what has been the growth, like I said, maybe 5 years back in India, the ETF AUM was less than maybe 10,000 crores, less than 5,000 crores. But today it is crossing 2 lakh crore. The reason is, of course, with pension industry growing. So that's the growth. And in terms of the management of ETFs, the mutual funds, like they manage any other mutual fund instrument within the laws and regulations, they manage the ETFs as well. As a mutual fund, as an asset management company, where we basically come in is that we have to ensure we are managing or replicating the index to the extent that it is possible to reduce the tracking error. Now, what is this tracking error? Tracking error is how different is my portfolio or the investment ETF versus the benchmark index, which is just trying to mirror. Think about having to basically have an index where there are, say, 30 constituents or 50 constituents, and you're trying to replicate the index constituents and weightages. Obviously, because of the fact that you are practically buying and selling on the exchange all the 50 stocks, there may be some slight variations which are there in the portfolio compared to what the index has it. And there will be dividends which the index may basically, or the index constituents may give out. That dividend, of course, comes to the ETF. So your NAV in the ETF goes up to the extent, but there is a time delay between the dividend declaration as well as the receipt by the ETF. And hence, from a perspective of tracking error, that also impacts. Also, from a regulatory standpoint, while 100% investment is something which is there in any ETF, practically 99.95, 99.96 is what an ETF would be invested in for practical reasons. That also brings in an element of tracking error or dispersion. And of course, there is an expense ratio. So the expense ratio is something which is borne by the scheme, and that basically also adds to the tracking error. So on an overall basis, while investors obviously should be aware of the facts that ETFs are one of the low-cost ways of investing, tracking error is an important element which is there. And while in India, almost all schemes try to bring in the tracking error lower, what is obviously important is, as an investor, do you have enough liquidity on the exchanges? And I think from the perspective of liquidity on the exchanges, how is that ensured? All asset management companies appoint authorized participants. So from an ETF perspective, think about you being an investor. There is an exchange on which the ETF can be bought and sold. But because it's a concept which is new in India, it's not always that you'll find high liquidity on the exchanges. So there are authorized participants which are appointed by the asset management companies to ensure that there is liquidity on the exchanges for you to buy and sell. That's the softer aspects of ETF in terms of ensuring liquidity is there on the exchange. And as an asset management company, all asset management companies appoint authorized participants to ensure that the ETF is trading very close to the NAV, so that you as an investor get the benefit of buying the ETF or selling the ETF as close to the NAV as possible. Also, of course, there is a concept of basket buying or selling, which larger investors beyond a basket size can come and buy with the AMC. So, say for example, the basket lot size of a particular index is a 1 lakh unit, and the ETF is trading at 25 rupees. So if you are investing more than 25 lakh rupees, you have the choice. You have the choice. In this particular case, 25 rupees as an 25 lakh rupees as an example. Suppose a basket size is say 30,000 units and the ETF is trading at 100 rupees, then it is basically 30 lakhs. So whatever is the basket size of that particular ETF and whatever is the unit price, you multiply that, you get the basket size in rupees lakhs or rupees crores. And if you have basically that much investment to be made, then you can basically reach out to the asset management company and get the units created in kind or units created with the asset management company. That's one of the other ways of liquidity creation which is possible. So just to summarize or recap till now what we have covered. One, the ETF started globally somewhere around the 1960s, 70s as a play on passive investing, as a play on beta, basically trying to get market returns. While till then, of course, alpha, which is essentially fund management generating alpha, was something which was very, very popular. As we move along, of course, in India, we've seen over the last 20, 25 years, active funds have basically grown. And in India, we firmly believe with financialization increasing, with our GDP increasing, it was $1 trillion in 2008. It is almost $3 trillion expected in 2023-24, or maybe slightly earlier than that. And if we reach $3 trillion, our savings rate also increases, or rather our savings increase in absolute terms. That savings has to be invested somewhere, and we've seen a growing trend of financial investments happening. So in India, across all financial aspects of financial products, there is a growth which is potentially possible. And within that, we feel that active funds and passive funds both will coexist and grow, including ETFs, index funds, and active funds. And within ETFs, especially with the kind of innovation, with the kind of new products which are coming in, that will definitely help investors to seek and choose the product of their choice and start investing. So from that perspective, if we see, let's jump into what are the kind of ETFs which are there, or what are the types of ETFs which are possible from a perspective of the investor. What is it that is available? So in the industry today, in the ETF industry in India, thanks to the last 3-4 years, many new products coming in, we have equity ETFs, which are taxation-wise taxed as similar to equity products or equity shares, which is if you hold the ETF for more than 12 months, you get taxed at 10% plus some surcharge. If you hold for less than 12 months, then short-term capital gains apply, which is 15%. So an equity ETF is taxed similar to equities in India. And if we see from the perspective of types of equity ETFs, there are pretty much a lot of options there. There are large cap ETFs, there are mid cap ETFs, then there are within the large cap ETF, if I have to say, there are ETFs which are tracking the first 50 companies by market cap. Then there are ETFs which are tracking the 51st to 100 company by market cap. There is an ETF which covers probably first 100 companies by market cap. So you have various options within large cap. Within mid cap also there are options which are available. Then of course, if I look at the thematic basket in terms of sectors which are there, you have various sectors on which the ETFs are available today. There is banking, there is information technology, and I believe as we move along, there will be other sectors also on which ETFs will be there. So for those investors who are very keen observers of the market and want to participate in sectors at a basket approach or as a passive approach, they may get opportunities, let's say in banking, information technology, etc., and then the newer schemes which may come up as we move along from the perspective of offering. I see that bouquet widening on the thematic sectoral basket. The others, of course, are the Smart Beta ETFs, and a lot has been spoken about Smart Beta ETFs, written about Smart Beta ETFs, especially if we look at it globally. The dividend yielding Smart Beta ETF has something which has picked up a lot because globally interest rates are zero or very low, and dividend yield is something which has done well for them. So dividend yielding Smart Beta ETFs are something which is picking up globally. What does Smart Beta ETF mean? So I've already covered equity ETFs, which are on the market capitalization stage, which is large cap, mid cap. Then there are themes or sectors such as banking, information technology, maybe infra at some point of time. So those are the themes which may be available or are already available. And then, of course, if we look at it from a perspective of Smart Beta ETFs. That concept is slightly newer. It's probably in the last 10-15 years that it has evolved even in the Western world, wherein the selection of securities is not based on a sector or on market capitalization at all. The selection of stocks is in the Smart Beta ETF is based on some amount of or factors which are different factors which can be chosen. So for, let's say, for example, you first select the universe of stocks, let's say top 100 companies, and within the top 100 companies, you pick up the 30 lowest volatile stocks. If you pick that up, that becomes basically a ETF wherein the stock selection is basically happening on the basis of a factor which is low volatility. What does low volatility mean? Low volatility means those stocks which have low volatility relative to the market, and basically we've seen over a longer period of time, stocks which are low on volatility or are stable, they tend to provide better risk-adjusted returns, because the concept of risk-adjusted returns is what is the return per unit of risk, and risk is measured in standard deviation. So without getting too technical about it, Smart Beta ETFs are simply picking up factors. It could be dividend yield, like I said. It could be volatility. It could be alpha. Alpha meaning the stocks which have done well in the last 6 months, 12 months. If you pick them up, which have delivered better returns than the market, and if you select those stocks, then of course that becomes a set of stocks which are basis alpha or momentum. And of course, along with the stock selection, in the case of Smart Beta ETFs, the weightages of those stocks can also be determined by the factors themselves. So the stock which has the lowest volatility, in the example which I gave, can have the highest weightage in terms of the relative weightages which are there. So many options are possible, many factors are there in the in the investment world. But in India, of course, it is a very nascent stage again. ETFs itself are nascent, and within that, Smart Beta is anyways a new concept which is probably just about picking up. In our experience, in terms of our interactions, there is a set of investors who are pretty much interested in Smart Beta, and they are looking at that space because that gives them some amount of ability to, get a differentiated product. But I think from an ETF overall perspective, it fits the investor's bouquet for sure in terms of adding to an overall investor diversification basket. And within equities, like I said, there are enough options available. The second category within ETFs would be debt ETFs. I would say that's again something which probably got more popular with the government divestment mandate, and I think it is something which is very, very nascent, and it is likely to pick up, wherein investors can invest in debt through the ETF route, but it's something which is very new. I think over the next few years it can pick up. The last part is, of course, commodity ETFs, and I think that's where the gold comes in as a option for those investors who are looking at investing in gold in financial form. And as we all know, with the amount of money that central banks have printed, let's just give some examples. I mean, while I'm obviously speaking of ETFs, I'd probably just add on a bit of, let's say, what's happening in the market as well. Just my understanding of what and how the actual numbers are. So back in 2008, the central banks had a total balance sheet size of $5 trillion or $6 trillion. Today, the total central bank balance sheet has gone up to $20, $24, $25 trillion, and it is rising. And in the last 1 year alone, since the pandemic, almost $5 to $7 trillion of extra money has been printed by the central banks. Now, why is this important, and are these numbers important? Probably numbers is something which you may not catch because you're not following the market that closely. But a $5 to $7 trillion of money printing by the central banks or additional liquidity provided by the central banks is significant. And normally, whenever such an increase in liquidity happens, gold may benefit or does benefit, to an extent. And what will happen in the future is something very difficult to predict. But from what we see in terms of the money available in the market, there is scope that gold as an asset class can act as a good hedge against inflation, because with all the money which has got printed in the world, there is a chance that inflationary environment may come back. That's where, if you see, probably you read newspapers, etc., commodities are becoming more and more well priced, or commodity prices are going up. And in sync with that, probably gold may also catch up at some point of time. So gold ETFs are simply products which are allowing you as an investor to invest in gold without actually going and buying physical gold. So you get units which are backed by physical gold. So the transaction is pretty simple. Every time you put your money in a gold ETF, that money is basically used to go and buy equivalent amount of gold by the scheme. The scheme basically has a custodian which keeps the gold, while you get the units which you don't need to necessarily secure, because they are all digital units, etc. So you don't have to worry about the safety or security, and you can buy and sell them on the exchange. So in very simple terms, gold ETF is a very convenient way, a safer way probably, because you may not need to physically maintain the gold, and also an easy way, especially the pandemic times, wherein you can actually sit back at home and through your mobile phone app or your online, whichever way you actually transact your mutual funds, you can buy the gold ETF through the stock exchanges on your into your demat account. So gold ETFs are becoming popular because of the ease in which you can invest in the yellow metal. And from a diversification perspective, from a asset allocation perspective, we believe 5 to 10% allocation to gold, given where equities are today, given where debt market yields have already fallen, may not be such a bad idea from a risk diversification perspective and a risk hedge perspective. So that's on gold ETFs. Of course, from a perspective of, let's say, gold as a commodity, I've already covered what we feel. So equity, debt, and gold are three major classes of ETFs which are available. And within equities, of course, I've already covered what all are there. Now, again, the advantages of investing in ETFs is one more topic which investors definitely would like to know about. So the clear advantage and the biggest advantage, as I see it, is that from an investor perspective, you exactly know what is the methodology of the underlying investment. So if it's a large cap universe if it's a large cap index fund or ETF covering the top 50 names, you know that at all points of time you'll be getting those top 50 names in the index proportion, right? So there are pros and cons of every type of investing. The pro of ETFs is that you know exactly how much your money, or what is the index and the methodology which is there in terms of the investment which is happening. Of course, index ETFs are low-cost products, which is fine. And from a perspective of real-time NAV, like I mentioned, you can go and buy and sell on the exchange at the live prices, which can help you to capture any market movements which are very significant or vigorous, and you may want to take the advantage of that. So those are the broader advantages of ETFs. There are many ETFs possible in terms of your choices. So it does require some element of your reading, your understanding, and that's where a financial advisor can be very useful in making you basically aware of what are the options that you have. How should you first and foremost decide your risk profile? Based on your risk profile, how you should have your asset allocation. And once you've decided on your asset allocation, which areas of the market and how would you put, let's say if you're dividing your money into equity, debt, commodity, real estate, etc. Within equity, active, passive, there are options. How would you proportion that? And within active and passive, which are the funds which you select? So there are various steps which are there. You may or may not have time at all points of time to follow so many things which are happening. And that's where a financial advisor can be very useful to help you guide through and navigate through and have a right balance, right asset allocation. And within the right asset allocation, of course, ETFs do provide a good way of not just diversifying your portfolio, but also to have a portfolio mix which is well balanced in terms of active and passive. So, like I said, I firmly believe active and passive both are complementary, and we will find in India the growth happening across all financial products. But as an investor, to ensure that your money is invested in a sensible manner, it will be very useful if you actually have a financial advisor to help you form your asset allocation. And then based on the asset allocation, construct a portfolio for you in terms of where your money should be. And again, as we earn every month, as we save every month, it becomes imperative to invest every month as well. And the more we invest at an early age, the better it is. So not just for ourselves, but also for our children or youngsters. it is important to have the saving habit, and more important than the saving habit, to have the right investing habit. It's not something which is taught to us in school or college, unfortunately, in India that easily. So we learn it sometimes on the go, or we learn it once we grow older, but it does help if you have already a framework, an asset allocation mix, and the right assets which are basically created for you or advised to you by a financial advisor. It will become very, let's say it will become easier for you to navigate through the financial world, because over the next 10 years or so, now the next 5 years, there are many ups and downs which are possible because of various reasons. And while we can't predict what will happen tomorrow, what we can do in terms of our assets and our financial investments is completely in our control as of now. The next part of the question, of course, is what types of investors should consider investing in ETFs. Now, very clearly, as I see it, all investors may consider investing in ETFs. If I see from the perspective of asset allocation in a mix, there are virtually across categories ETFs available, and as the number of products keeps growing, as the sector thematic Smart Beta ETFs keep growing, I would say that in passive investing itself, you will find options which will fit your overall bouquet. At this juncture, of course, I'd also like to say that, again, at the cost of repetition, there are times and market cycles wherein a certain set of stocks do well, a certain category does well. In the past 2-3 years, many of you would have heard that it's only the index which is moving while the rest of the market is not moving. The main reason, of course, for that would be that when the economy is not growing through a big bull phase, or it's not growing very fast, and very few number of companies end up garnering some amount of growth at a time when the rest of the market is not growing or rest of the stocks are not growing, invariably investors, be it foreign investors or even local investors, will flock towards those few stocks. And in India's case, over the last 3 years, it's the top 10, 12 names and among the large cap index which have done well, while the rest of the market since 1st of January 2018 has not probably performed that well. So there was a phase in the market in the last 3 years after the bull run between 2014 to 17 that because of the low growth in the Indian economy, the wider basket of stocks or the wider market was not participating. The rally was very narrow, and that basically helped some of the ETFs which were large cap based ETFs do very well. They definitely deserve an allocation in your portfolio, but I would say that over a longer period of time, India being a growing economy, there will be times when you will find differentiated products apart from the large cap ETFs doing better. So at the portfolio approach, you need to have probably a good bouquet of products which will help you at a portfolio level generate better returns and create wealth for you. And hence, don't put all your eggs in one basket. In other words, don't just go by past returns. Don't look at past returns and invest all your money in a particular product, because it is not necessary that that product will deliver the best returns for you in the next 3 years. What has worked in the past 3 years may not work in the next 1 year, 2 years, 3 years. And hence, just be careful of the fact that when you are investing, don't look at past returns and invest. It is true for active funds. It is true for passive funds. It is true for ETFs as well. So hence, a diversified bouquet, and more importantly, is your asset allocation. And within asset allocation, I firmly believe that all investors who have a demat and trading account can and may invest into ETFs. Different ETFs will fit different investor demands. So depending on your risk profile and asset allocation, you can definitely invest in the ETFs which are available in the market. With that, probably I will come to the Q&A. There are, I'm sure, questions which are there, so feel free to put it on the chat box and I will try and answer those questions. I'm just having a look at some of the questions which have come up while we are waiting for people to put on. So if you have any questions which I have not covered, or if you have any questions on ETFs, please feel free to ask those questions. We'll be happy to answer those. And if I'm not able to cover them in this conversation, our team will probably reach out to you and answer those questions as well. So just trying to basically log into the Q&A. Just give me a second. Okay, the first question. The first question is essentially from Mr. Imad Sirkot. I read somewhere that ETFs trade close to its NAV. What does this mean exactly? Thank you for asking that question, and I think it's a very fundamental question from a ETF perspective. Sometimes we don't tend to explain the basics, and thank you for asking that question. Okay, so let me answer that question. Thank you, Mr. Imad Sirkot, for asking that question. One, like I said, ETF is nothing but a scheme, right? An ETF is nothing but a mutual fund scheme. And as you are all aware, a mutual fund scheme, right, has an NAV, meaning at the day-end prices, closing prices of each stock, what is the net asset value of that particular scheme? What is the closing net asset value of that scheme? That's the value of the scheme based on the closing prices. However, the ETF which is trading on the exchange, right, it is being bought and sold by market participants. You could be a buyer, you could be the seller, someone else could be a buyer, seller. And of course, theoretically, the price on the exchange should be similar to the price of the NAV which is there, but there can be slight differences because of obvious reasons, right? Buying, selling, etc., buyer, seller, demand, supply, etc. There will be slight differences. That essentially is the concept of saying that ETFs trading very close to the NAV. So the NAV is essentially the underlying scheme, which is the mutual fund scheme. The underlying scheme, NAV, at the closing prices, and the ETF, if the closing price of the ETF and the NAV are similar or same, it means that it is tracking it properly. Even through the day, for example, if you go on the website, even through the day, you will find the live NAVs on websites of ETF providers, and you will know, okay, if for example, an ETF is trading at 20.25 and the live NAV is 20.20, you'll know, okay, 5 paisa more ETF is trading at, or 2 paisa more ETF is trading at. So essentially, that's the concept of ETF price, which is on the exchange, trading closer to the underlying actual NAV of the fund, because ETF price or the exchange price is determined by the buyer and seller on the exchange. It can move up and down beyond the actual NAV. And if there is very big disparity, let me also highlight. Suppose the NAV is 20, and if the on the exchange there is a trade happening at 21, 22, there will be authorized participants. There will be people who will basically bring it closer to the NAV, so that the buyer and seller are able to buy it closer to the NAV. Very rarely, in exceptional circumstances, when authorized participants aren't able to basically participate in the market, maybe because of certain timing reasons or otherwise, our market is not efficient, the ETF price and the NAV are different. Otherwise, normally, the ETF price and the NAV are very close to each other. That's the concept of NAV and ETF price. Thank you again. The next question is from Gauri Morajkar. How are they different from close-ended funds? Excellent question again, very pertinent. What is a close-ended fund, right? A close-ended fund is a fund wherein the money is raised at a particular point of time in a particular underlying offering. It could be an equity close-ended fund, it could be a debt close-ended fund, it could be a hybrid close-ended fund. So the underlying may be defined earlier itself, And once the money is taken, you will know it's taken for 1 year, 2 year, 3 year, 4 year, depending on the tenure. So as an investor, what you are getting is a close-ended fund wherein the underlying, let's assume a close-ended fund which is on the basis of equity. The money is raised, say, in 2017 with a 4-year period. So it matures on 2021. So the fund management team will basically, which has received money in 2017, they'll manage the scheme basis the objective of the scheme. They'll manage your money basis the objective of the scheme. And it is not passive. It is not necessarily mimicking an index. It is based on whatever is the objective of the scheme, which has basically been brought out. So that's a close-ended fund. A close-ended fund is not mimicking an index. Yes, close-ended funds also, because of regulatory reasons, they are needed to sometimes list on the stock exchanges. But the difference is a typical close-ended fund, the underlying is not replicating an index. It is not copying an index in terms of its weightages and in terms of its scripts. While an ETF, which is based on an index, is ETFs always track a particular index in terms of its weight also. So that's the key difference. Close-ended funds, of course, mature. So like in this case, 2021, 4 years, if the maturity is there, they mature and the money is either redeemed or if there are any other options in terms of conversion, etc. But in the case of an ETF, you buy and sell on the exchange, or you basically create units or redeem units with the AMC. It is an ongoing scheme which continues. It is not close-ended. It is not something where your money gets locked for 3 or 4 years. You can buy and sell on the exchange. Even in the case of close-ended funds, of course, you can buy and sell on the exchange subject to liquidity. But the close-ended funds are not mimicking the index. The next question is essentially on the next question, as I see it and I understand from Mr. Jayanta Mondal, is, are ETFs meant for the long term? Equity investments by themselves are meant for the long term. And if you're investing in equity, what is essentially equity investing? Think of it as you are investing in a business. If you're running a business and if, for example, you or your family has a business, you don't generally want to sell the business as such and you want to continue to grow the business. Of course, there will be times when you have a big investor ready to invest and you sell. That's a different story. But generally, you want to grow the business yourself. Similarly, when you're investing in an equity fund, be it an ETF, active fund, passive fund, when you're investing in equities, you are participating in the long-term growth story of equities in India. And hence, the longer you keep, the better it is. So, yes, even ETFs, if you keep your money for the longer term, essentially the underlying companies which are there in the ETF, they will grow along with the economy. Now, of course, within ETFs, there could be sector thematic ETFs which have their cycles, etc. That's the complications which are there. But in general, if you basically invest in a broad market cap based benchmark index, which is generally known of 50 names or 30 names or 500 names, then you are basically participating in the market as such and the growth of the country. So as the country grows, so does its GDP. So India moved from 1 trillion in 2008 to almost 3 trillion now, or maybe in the next 1 or 2 years we'll reach 3 trillion. Along with moving from 1 trillion to 3 trillion, there are companies whose profitability has grown. You're seeing them all over, right? Banks which have grown, paint companies which have grown, FMCG companies which have grown, auto companies which have grown. I think about 25, 30 years back, we would be selling 5-6 lakh cars a month, 5-6 lakh cars a year. Today we sell 35 lakh cars. We are the 4th largest car market. So as the economy grows, the companies grow. As the companies grows, the equity valuations or equity market capitalizations grow. Now, of course, some companies grow, some companies degrow. There is a cycle within companies as well. But in very simple terms, with very easy terms, if you invest in the benchmark broad market indices, you do get to participate in the long-term growth story of any country. And within equities, of course, you keep investing for the long term is what I would say. Don't think of equities as a short-term instrument wherein you'll play, invest and get money in 3-4 months and quickly get out. then you're probably setting up yourself for trouble, because the difference between people who make money in equities and the people who don't make money in equities is very simple. Those who try to time the market necessarily do not make money in the market. Those who do not try to time the market and remain invested in the market in the long run, they are the ones who generally have basically made money in the markets. Because the prices are traded every day, because the quotes are there, because you are basically staring at prices ups and downs, equity is much more volatile. There is always this greed and fear which comes in, wherein whenever the markets fall, you want to first take away your money. It happens to everyone. It happens to people, finance professionals as well. We also get frozen in terms of our mind, and that's where having a sound financial advisor is very, very important. And don't underestimate the importance of having a sound financial advisor. So yes, equities is meant for the long term. Do not, let's say, invest in equities with the thinking that you will invest and quickly make money and get out. That may work well, but it's not something which will always happen. I think I've covered all the questions and we've pretty much run out of time. It's 4:41 approximately. We are at the fag end of 2020. It's been a very interesting 2020, wherein it started on a high. We saw the pandemic and probably first time in most of our lifetimes we've seen a lockdown. And now, of course, with the vaccine coming in, things are looking optimistic from an economy front. So wishing you and your family a good Christmas, a New Year's, and a happy 2021. Definitely will connect with you again in 2021 some point of time. Appreciate your time and patience, and thank you for listening to us. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.